Good morning, everybody. Mike Niemiec here with some early morning grain and oilseed comments to start off this week, Monday, February 12th. Last week, we had a USDA report. We found out that the USDA went and raised the bean and wheat carryouts by lowering exports, making their carryouts still quite burdensome. We still have quite burdensome corn carryouts as well, even though they lowered the export numbers. And actually, that's on the heels of a non-bullish January report, but really didn't seem to matter to the marketplace fundamentally. Price-wise, we wound up closing the wheat markets up around 2 cents, corn unchanged, beans up $4, but the big star still being the soybean meal, up around $9 versus the anti-oil spread, down around 55 points. Everything shot up in the overnight trade, led by the meal and the beans. Meal making new contract highs, up around $7 at this point in time, dragging the beans along up around 15 to 20 cents. But we also had the other markets carry along as well. We got wheat market up around 6 cents, corn up around 3, and even the soybean oil market's up around 10 points. It's probably a little bit twofold. South America will probably be one of the topics as far as the traders go for the overnight strength. It's kind of a little bit threefold, maybe twofold in here. The weather in Argentina, it's still, we're getting some rains, but not enough. I think the trade generally wants that magic word, a soaker, and it's just not in the cards right now, so the trade's still a little bit worried about that. That kind of keeps the hedging at bay as far as overhead selling goes, and that lack of selling by the farmer in Argentina is also slowing their crush, thus least meal and soybean oil availability, and thus providing the support to the meal market. Plus, we're also awash with veg oil, so that's why the oil market doesn't really react to it at this point in time. Then also with that weather, the slowing of the Brazilian harvest there too, running behind, lack of hedging coming in the marketplace. So the lack of selling, lack of hedging, all kind of goes twofold with what's been going on with the commitment of traders report. And that's probably more of the story, but nonetheless it is important with the South American weather. We've seen once again the big decreases in the net short positions by the soft red winter wheat, corn, bean guy, and in the soybean oil as well. And then the other one, the magic one, soybean meal, after getting almost near to unchanged, they've now exploded their position up to around 50,000 lots as of the last commitment trade report, and since then maybe added almost 20,000 more to almost a level of 70 to 75,000. So you can see with the trade getting long the meal, it's helping the crushing margins. We don't have the hedging in South America. The trade is short covering their net short positions, and thus the updraft that we are seeing. We'll get we'll get weekly grain inspections coming out here later this morning. I don't know, all said and done, fundamentally, still doesn't sound like the type of carryouts that we have. It's a plus $5 wheat market, a plus $4 corn market, but certainly with a big jump in the bean carryout to 500,000, I don't know, it doesn't really seem like a plus $10 market, but that's where we're at. Once again, these are my opinions, not that of ADM or ADMIS. Thank you.